Imagine this with me, okay? You're an Italian tax resident or simply a new tax resident of Italy. And you own a beautiful apartment in, let's say, London or a holiday home in France. You decide to sell it. You make a profit. You think, great, this property is not in Italy. It's not an Italian asset. I'll just pay the capital gain tax in the country where the property is located. That's the end of it. You feel confident. You feel you've handled it correctly. Indeed, the Italian government can tax the same capital all over again. Let's start with a fundamental principle of the Italian tax system. Once you become an Italian tax resident, you're required to declare all of your worldwide income. This includes income from a job, income from a rental property, and yes, income from capital gains, no matter where in the world those incomes come from. So if you sell, when you sell a property located outside of Italy and you make a profit, that profit is considered capital gain and is considered income in the eyes of the Italian tax authorities. You must declare this gain of your Italian tax return. Now, this sounds like you're going to be taxed twice, right? Once in the country where the property is located, and again in Italy. And for many people, this is exactly what happens. But here's the key. Italy has a mechanism just there to prevent this, but this is not automatic. It's a tax credit system that you must actively claim in your tax return. And you can use the taxes you paid in the foreign country on the capital gain as a credit against the taxes you owe here in Italy. The problem is you must know how to properly calculate and apply this credit. And if you get it wrong, or if you simply don't declare the capital gain at all, the consequences are severe. The biggest mistake people make is not knowing that they have to declare their gain in Italy in the first place. Now, let's see real life what happens. Meet John. John is a British citizen who lives in Rome and is an Italian resident, of course. He owns a flat in London that he bought 10 years ago for, let's say, 200,000. I know the real market works on a different level, but just to understand the logic, I'm using simple numbers. He sells the flat for 300,000, making a capital gain of the difference, 100,000. He pays the capital gain tax in the UK, which is around 20,000. He thinks, great, that's done. Now I can just enjoy my net profit. But John is very, very wrong. If this video helped you even a little bit, make sure you hit subscribe. We've got a lot more coming. And before you book a one-on-one session with us or you hire us for any tax-related service, take a moment to check our digital store. We've built a complete collection of guides, masterclasses, templates that already solve more than 80% of the real-world tax questions expats face in Italy. You will find everything directly in our store. The link is right below in the description. Because John is an Italian tax resident, he must declare that 100,000 gross capital gain on his Italian tax return. So the Italian tax authority, through information sharing agreements, the common reporting standards, can find out about the sale. Let's say the Italian capital gain tax rate on this gain would have been around 26%, which is exactly 26,000. John, back in time, should have declared the gain and used the 20,000 UK taxes as a credit. He would have then owed just a difference of 6,000 to Italy. But John did nothing. He didn't declare the gain at all. A few years later, the Italian tax agency finds his undeclared gain, a hidden profit. They send him a letter demanding a full 26,000 Italian taxes because he did not file a return and he did not claim the credit. They also add massive penalties for non-declaration, which can be between 120 to 240% of the taxes owed. So John's simple oversight of not declaring the gain could turn potentially into a 50,000 retroactive tax bill instead of just 6,000 tax bill difference. Now, let's look at another more complex scenario. Meet Maria. Maria, she is an Italian tax resident who owns a holiday home in France. She sells it for a capital gain of 80,000. She pays the capital gain tax in France, which is around, let's say, 15,000. She hires a local Italian commercialista to do her tax return, and she tells the advisor about the sale. In this case, the advisor, not being an international tax expert, of course, doesn't know the specifics of the Italian-French tax treaty. The advisor simply declares the 80,000 gain and applies the full 26% rate in Italy, which is around 21,000, rounded up. So Maria pays the full amount, believing she now owes a total of 15,000 in France and another 20,000 in Italy. So she's a victim of dual taxation, and honestly, that sounds like a lot to me. But a true experienced international tax expert would have known the right process. They would have declared the gain and then applied the 15,000 in French tax as a credit towards the 21,000 owed in Italy. So the correct amount Maria should have paid was just 6,000 difference. Because of her advisor's lack of expertise, Maria has overpaid her Italian taxes by 15,000. And this is not a one-time thing. These kind of mistakes accumulate over the years, costing families tens of thousands of euros. So what's the lesson here? Capital gains from foreign property are absolutely taxable here in Italy. Yes, we still have to apply the 5 years rule, but this is something we'll address in another video. The biggest and most costly mistake is not declaring the gain at all. The second biggest mistake is declaring the gain but not correctly applying the foreign tax credit. Penalties for these mistakes are not small.
At Studio Rigo, we provide tax and strategic guidance for those navigating international complexity with significant interests in Italy. We work quietly, precisely, and always with the long term in mind. If you expect nothing less than clarity and control, you'll know where to find us. Thank you for watching. See you in the next video.